Now I'm going to start my slideshow. And thank you all yet again for joining me tonight. This is MEFA's Saving for College presentation. My name is Jonathan Hughes. I'm the Associate Director of College Planning and Content Creation at MEFA. So I've worked for over 20 years at MEFA, answering all sorts of questions from parents and from students about planning, saving, and paying for college. And saving is probably my favorite thing to talk about because I know what it can do and how useful it is for parents and for students when they get to college, and the effect that it has on college attendance. And we'll speak to that a little bit during this presentation. Before I get into the subject of the presentation, I want to tell you a little bit about MEFA. MEFA is the Massachusetts Educational Financing Authority. We're a not-for-profit quasi-state authority. We were created back in 1982 by the Massachusetts State Legislature, and we have a public service mission to help families to plan, save, and pay for college, and we do that in a variety of ways. The first thing that we were created to do was to offer a loan back in 1982, which is something that we still do for college students and their families. But, since 1982, as the cost of college has continued to rise, simply offering a loan was not sufficient. So we have two savings programs, which we'll talk about tonight: the U Plan, prepaid tuition program, and the Massachusetts 529 plan, or the U Fund. And you're probably familiar, maybe some of you, with 529 plans. We'll talk about those a little bit tonight. And so what we're going to talk about in general, we're going to break this down into four parts. The first one is the why save for college. And so if you're here listening to this presentation, you probably have some idea that saving for college is important. We'll talk about why that is and the effect that it has on college attendance and on financial aid and things like that. We will talk about two specific Massachusetts savings options, the ones I just mentioned, the U Fund and the U Plan. I am always clear to say that whatever way you can save is a good way to save. So I'm, more concerned than anything that you just start saving rather than how you save. However, there are some ways to save that, when used for college, do go a bit further. They're specially designed for use for college, and they have special benefits associated with it if you use these savings vehicles for college or for post-secondary, which is after high school education. So we'll talk about those specific plans. And then we'll talk about general strategies for savings, what some families do, what's worked for them, what we know works in general. We'll give you some ideas of how you may be able to save more effectively for your students. And then finally, we're going to wrap it up with how families do actually pay for what we call post-secondary education, right? So that is college, but it's also career training. So the idea is that not everybody has to go to college. Not everybody will go to college. And that's fine. You just want to have your students be in the best position to succeed in whatever they want to do after high school. So that's going to take some planning, no matter what it is, and probably some saving as well. But also, I think it's important because specifically when you're going through, as I said, I've talked to many, many families over the years when they get to paying for college. And the big question they want to know is, how do families do this? So we'll talk about that. So you have a question. Now, if you have any questions throughout, please submit them through the Q&A. I will answer them as I go, unless I know that we're going to be coming to that answer later on, or if I think it's maybe better served after, if we need to get into something, personal or in the weeds, we can talk afterwards. So somebody has a question about 529 plans and its impact on financial aid. I am going to wait on that because we definitely talk about that in the presentation. It's a good question. I'm glad you raised it. We'll definitely talk about it. But please keep them coming. Okay, so first section, why save? So we put this right up front because this really kind of is the heart and soul of this presentation. This is the most important slide. This is something that we hear all the time, and I have had sort of arguments about in my daily life with, not through MEFA necessarily, but talking with family and friends and things like that. Things we've heard is that my savings will hurt my financial aid, just like your question just said. The truth is that income is the biggest factor in determining financial aid eligibility. So when you get to the point where you're filing your financial aid forms, you're sending your children to college or going to college yourself, and you're filing your FAFSA, which is the free application for federal student aid, which some of you may have heard for. It's the form you have to file and send to every college that you're going to if you want financial aid. Some colleges may want additional forms, but they ask you to list all of your financial information, right? So your income, your assets, the student's income, the student's assets. And they put it all through a formula, and they arrive at this number called the expected family contribution. And that's the amount that the formula feels that you can absorb for a year in college. Not necessarily pay out of pocket per se, but the amount that you're going to be responsible for. Within that calculation, your savings, your assets, the parents' assets, that is, have a very small percentage of the weight in those calculations. Anywhere from about 3 to 5.6% of your eligible assets are going to be taken into account as to what you can afford to pay for that year for college. So if you have $10,000 in assets, the most that's they're going to expect you to use out of that is about $560. Now you contrast that to income. We'll look at anywhere from 0, it's on a sliding scale, anywhere from 0 to 47% of your adjusted gross income in the previous year is what they will take as, what you can pay for college that year. So it's definitely much, much, much more weighted towards income. And it definitely doesn't even come close to the benefit of actually having the savings to pay. So it may reduce your eligibility for aid a little bit. It may not, but it may reduce it a little bit. But as I said, nowhere near to the point where it cancels out the value of actually having the asset to pay. The second thing is it's not worth saving for college if I can't save the entire cost. So when my son was born 9 years ago now, I remember my colleagues went to a future college cost calculator, which is something that we have on MEFA.org. And if you're curious, you can check it out. She said, let's see how much college is going to be for your son when he turns 18. And we picked like a private 4-year college in Massachusetts or New England. For 4 years, it was a huge cost. And so I had that reaction that most people would have when they saw the price tag. And I thought, oh my God, I can never save that full amount. And that's true. I probably can't, but I know that I won't actually be charged that full amount. Very, very few families are going to be asked to pay that full sticker price of college. There is financial aid available that the vast majority of families qualify for at least some level of financial aid. And so after that's counted, your savings can start to eat into that amount due. So as we say, every little bit saved towards college will help. Even having a small amount over time can add up. So your college savings will help you. It can give you more education options. It can open the door to different types of colleges if you have some savings. You can look at other types of colleges that maybe you wouldn't have been able to without them. Some programs as well that aid does not cover, like study abroad programs. Really, the biggest thing for me is it can reduce or hopefully even eliminate the need to borrow loans. But the reduction in borrowing loans is real enough. It has a minimum impact on financial aid eligibility, and that is something that we've already discussed, but it's worth repeating again. So it does not really harm your prospects of financial aid unless you have a huge amount of money saved, which in that case, you have a huge amount of money saved to pay for college. Now, one of the ways that we're going to talk about paying for college tonight is 529 plans, and they're probably the most popular, maybe most understood, the vehicle of choice to pay for college. And so we are going to talk about a seeded program later on called Baby Steps. There are programs where states, cities, municipalities, organizations will put money into a 529 account for children. And this is something that's becoming more popular throughout the country. Lots of states and cities, as I said, are doing this. And because of that, there's a lot of research that surrounds this whole area of seeded accounts, 529 accounts. And what they've found is that children who have savings Doesn't even matter the amount. If they know that there is money being put aside for them, they are, I think it's 3 times as likely to attend college and 4 times as likely to graduate. So it results in increased attendance and graduation rates. And this is true not just of higher income brackets, but across all income brackets. As you can see, this image here on the right is low to middle income children who graduate from college by savings amount. And no savings amount, no savings account is here on the left at 5%. Anywhere from $1 to $499, a small amount of money. Certainly if you're looking at the news and you see that college now costs, in the tens of thousands of dollars to pay, if you had anywhere from $1 to $499, you might not think that's sufficient. But in actuality, it really increases the rates of attendance and graduation. So fivefold, as you can see here. And then of course, above $500, it goes up, but actually not by nearly the amount that it did between no account and a little bit of money. So this is a motivating factor for kids. As I said, they have money set aside. They know money is set aside for them for after school, after high school. They're much more likely to meet those expectations and attend college. Okay, now we're going to talk about those 2 specific Massachusetts savings options that I was mentioning earlier. The first one we'll talk about is the U Fund, which is the Massachusetts 529 plan. And a 529 plan is a tax-exempt way to save for educational expenses, essentially. And so each state was tasked with creating their own 529 plan, and the U Fund is the Massachusetts 529 plan. It's a MEFA offering. And the way it works is this. You put money into your U Fund account. It's invested in the market. In the case of the U Fund, it's invested by Fidelity Investments. We have contracted with Fidelity to manage the accounts and manage the investments. So I have my U Fund account. When I call and I want to know about my U Fund for my son, I talk to somebody at Fidelity. And so the money grows with the market. I know the market's kind of a hot topic right now. I'll be honest. I'm not really a market watcher or anything. I don't really know much of what's going on with the market. I know it's not doing as well as it was last year, but hypothetically, the money grows with the market and it grows without taxes. And when it comes time to use the funds, you pull out the money. As long as you use it for a qualified educational expense, you pay no taxes on the earnings. So it's a tax advantage way to save. So what are eligible expenses? Well, there are things like tuition, fees, room and board, books, supplies, and equipment. And just because this is the Massachusetts 529 plan, it doesn't mean they have to use it at a school in Massachusetts. It can be used for any accredited college in the country that takes U.S. federal funding. Actually, can be used for some international colleges as well. As long as they take U.S. federal funds, you can use your 529 and not be subject to any taxes on the earnings. It actually doesn't even have to be used for college specifically. You can use this for career training or vocational programs, as long, again, as that institution is eligible to receive U.S. federal money. So there's a lot that you can use it for. The combined account maximum is $500,000. So not usually a problem for many people. If it is a problem for you, that's a good problem to have. But what that means essentially is that, I have an account for my son. Once you reach $500,000, you can put more funds in, or you're going to start to incur a gift tax. But if I have an account for my son and my mother also has an account for my son, those 2 accounts together cannot exceed that $500,000 limit. One important thing that I want to discuss, there's no annual account maintenance fee. And what that means is there's no fee that you'll have to pay out of pocket every year for this. There are fees associated with every 529 plan, but they're taken out of the earnings. At least, that's the case for the U Fund. And I know that the only time that I've actually seen anything regarding fees was when I was notified in the mail about a change to the fee structure. It's not really something that I noticed. There's no minimum investment to get started. So it used to be a $50 minimum. You had to put up $50 to that minimum investment. There's nothing now. So it could be $5, it could be $10. You can open an account with no money and fund it later. And this is an investment vehicle. So as it says here, and I mentioned the market and what it's doing now, and there are multiple investment options that you can choose. So we are not investment professionals, as I think I alluded to earlier, not qualified or able or really want to give you any investment advice, but this is where Fidelity can actually help you. So if you're setting up your U-Fund account, you're going through the application, you're trying to set it up, you will have to answer a few investment questions of how you want these funds invested. So if you're not sure, like I was not sure, you can call up Fidelity. They're available. This is their contact information down here. And they can get a feel, and they can advise you. They can get a feel for what you're comfortable with, what you're not, and sort of guide you through that process. Now, if you make a decision and then you talk to somebody later and you decide you want to change it, you can do that too. But you can enroll at fidelity.com/ufund, or you can call 800-544-2776. So those are qualified expenses. If for whatever reason you cannot use the funds for qualified expenses, there's a couple of things that you can do. First of all, you can wait. If the child finishes high school, they're not sure what they want to do, they don't go directly into a college or a program that they can use the funds for, you can wait and see if they do. You can also transfer the account to another beneficiary. So if there's somebody else that can use the funds within the family, you can transfer it to that person. If you do have to take a non-qualified withdrawal or withdrawal for an ineligible expense, then there are penalties associated with the earnings on the account, then not your investment, but the earnings. There's a 10% penalty on the earnings. And there's also the earnings will also be taxed at the owner's rate of income. There are 3 exceptions to the 10% penalty, and 2 of them are things that we don't really want to contemplate, the death and disability of the student. But the 3rd is scholarship. So if the student qualifies for a scholarship and you have to take the funds out and can't use them for those expenses because the student was awarded a scholarship, then you're not going to be assessed a 10% penalty on that amount. In all 3 of those cases, though, the earnings will still be taxed at the owner's rate of income. So I want to make that clear. The second program that we'll talk about is the U-Plan. And the U-Plan is it's a different savings vehicle. It's a prepaid tuition program. So it's not a 529 plan. It allows you to prepay up to 100% of the cost of tuition and mandatory fees at each participating college in the plan. So this is a program that has participating colleges built in. There's about 70 of them. They're all in Massachusetts. So it's a mix of public and private colleges. And the way the fund works is when you put your money in, your money's not invested in the market, actually. It's invested in bonds that are backed, general obligation bonds. They're backed by the full faith and credit of the Commonwealth. So it's not subject to market fluctuation. And there is a $300 minimum to purchase U-Plan certificates, what they're called. And so basically you put your money in, and depending on how much you put in a given year, that prepays whatever percentage of tuition that is at each participating college in the plan. And so, for example, if you put in $1,000 this year and you say, this is for my son's freshman year, 18 years from now or 15 years from now, you put in $1,000. That's going to buy 10% of tuition at a college that costs $10,000 this year. It's going to buy 3% of tuition at a college that costs $30,000 this year. Each college has a different tuition, so you're going to see a different percentage that you purchase at each college. When it comes time to use the money, let's say he attends that college that you purchased 10% of tuition at. Well, then in that case, since you bought 10% of tuition this year and said this is for his freshman year, he's going to have covered by the U-Plan 10% of tuition that year. So if tuition is at that college has gone from $10,000 to $20,000, well, then you have 10% of $20,000 or $2,000. So your $1,000 investment became $2,000 because you bought that percentage of tuition and that locked in that value of that percentage in the year that you purchased it. And you can add to your percentages each year. So, as you continue to save, you'll get an annual statement, shows you all the percentages you have at each participating college, and you can sort of decide and see where you want to focus. You don't have to pick a college right up front. You don't pick a college until the student is ready to go to a college. When that happens, we'll send you a form and you notify us where to send the funds, and we would do that. So it kind of locks in tuition or freezes tuition or a percentage of it, depending on what you put in at this year's rate for the future. The obvious question of that, of course, becomes what happens if the child decides not to go to one of those participating colleges? If that's the case, kind of like the U Fund, you can transfer the funds over to another beneficiary, or you can cash out, get what you put in plus the interest. Unlike the U Fund, there is no penalty for doing so, at least for Massachusetts state taxes or federal state taxes. So you get what you put in plus the CPI, and that's it. So that is the U plan. I know people generally have some questions about that, and it took me a little while to sort of absorb it. But the U plan is a really great plan, and can be very effective for saving, especially if they go to one of those if your students go to one of those participating colleges. So if you want to learn more about it, you can go to mifa.org/U-plan, or you can contact me when I send you an email. Oh, I want to talk about expanded 529 uses. I talked about how they're used for college and sometimes for career and training programs, but there's been an expansion in recent years as to what you can use your 529 plan money for and not pay taxes. So the first thing is textbooks, fees, and equipment for apprenticeships. That's up to $10,000 a year. You can withdraw and use for apprenticeships. Again, up to $10,000 annually for tuition for private and public K through 12 education. So that's something new. And as a one-time $10,000 withdrawal you can take to repay student loans. So these are expansions of how the 529 plan operates and what you can use it for. And in general, I would say that since 529 plans have been created, there really has been an expansion of how they can be used. Now, I want to talk about the baby step savings plan. I mentioned seeded college savings accounts that are becoming popular with states and municipalities. This is the Massachusetts seeded college savings plan. So this was announced I'm not sure when it was announced. It was started January 1st, 2020. And so all babies born or adopted in Massachusetts from that point on has $50 in a U Fund account. Once they open the account, or once the owner opens the account for the child, they can claim that $50 seed. They have 1 year to do so. And so this is really about trying to grow aspirations, trying to grow the culture of college savings, trying to reach folks who maybe normally wouldn't have opened up a 529 account, wouldn't know what it was, to do so. So they just need to check the box on the birth form that they're interested in baby steps. So if any of you have children that are months old, not yet years, or people who do, see if they have opened up their account to get their $50 from the baby steps program. So they open that account, money is seeded into the account, and then they can continue to fund that if they're able to do so, or they can choose not to. It's totally up to them. But this is a program that's been going on. It's on its third year now. We're very, very happy with the success of it. Again, trying to sort of grow that culture of college savings. There's one other sort of incentive to grow for people to start saving for college, and this is a tax deduction that you can claim for your contributions into either the U Fund or the U Plan. So Massachusetts tax filers, if they are saving for college through one of these plans, can deduct their contributions on their Massachusetts state income taxes up to a certain point. And that point is $2,000 for married filers filing jointly, or $1,000 for individual filers. And those limits are per filer, not per account. If you have 3 accounts and you put in 2,000, 2,000, 2,000, you still deduct only the 2,000 or the 1,000, whatever it may be. But it is, this is something that a lot of states have offered historically. Massachusetts started this think it was like 2016 or so, 2017, somewhere around there. And it was just became permanent this past year or two. So it's something that has, I think, been effective in spurring people to create these 529 accounts. Now, I do see another question here. What if I have two children in college at once? How will that impact their financial aid? And that is a tricky question because that is something that I think will change shortly. Right now, and it's going to depend, I think, too, on where you go to college. Let me explain a little bit about that. So right now, the FAFSA, the Free Application for Federal Student Aid, asks parents how many children they will have in college in the upcoming year. If they have one versus two or three, that's going to impact the amount that they are going to be paying for college, right? So it's going to lower their expected family contribution probably for each student. That question in the next year or two is going away. So you will not be asked that anymore. So it really won't impact your financial aid, unfortunately, at all. Now, that is, I will say something about that, and that is part of a much broader FAFSA overhaul and simplification that's being done. So when I heard about that, I thought, oh no, that's not good. You know, people with more than one child in school at a time are not going to be happy about that. But I was told that given everything in totality, the impact of that will be blunted by some of the other changes that are taking place within the FAFSA. So now, how it shakes out for every family, I don't know, and there's a lot we don't know yet. So it's a difficult question to answer. We just don't know at this point. And then the other thing is your college or the college that the student attends may also require, in addition to the FAFSA, a form called the CSS profile, or maybe they have their own additional form where they may take those things into account. So it's very difficult to say how exactly it will affect everybody at this point. A few years ago, would have been a simpler answer. I would be able to say, well, yes, they take that into account. But it's more complicated now, essentially. And so I wish I had more certitude for you, but unfortunately I don't. But as I say, I've been told that even though that question's going away, it's not the sort of burden that they think it might be. But a lot is yet to be done. So we're sort of on a wait and see on that, but I appreciate the question. Okay, so now we're going to talk about strategies for saving. So how have some people saved that we know has been effective for them? The first thing I would say is to start saving as early as possible. And I would never say it was too late to start saving. Obviously, anything that you save is something that you don't have to borrow. And so even if you have children in high school, maybe even the second half of high school, it's still worth it to put some money away, pay what you can out of pocket before you have to borrow. But like retirement or other things, starting earlier, the earlier you start, the better. You can start with a goal in mind, and we'll talk about that a little bit later on. As to some people, want to know how much they need to save, and that again is a difficult question to answer, but we have a tool that may help with that. Taking advantage of unexpected funds. So I know there's been some of that lately, whether that be tax refunds, or I know we had in the past couple of years some stimulus checks and things like that, and some forgiven loans even. You can take advantage of unexpected funds and use some or all of that, put that towards your college savings. Using automatic transfers is a very effective way. We know that people who use automatic transfers tend to save more than people who do not. And I tell this story all the time, but I will say that we were saving for my son after he was born for about 9 months using automatic transfers, and I didn't even know because my wife set it up and I never saw it come out of my bank account. And I just didn't know it was coming directly out of my paycheck. Which is something you can also do with the 529 if your employer does direct deposit. one of the biggest things, getting the word out to family and friends. This is not something that you have to do all by yourself. On the image on the right here, you can see an image of a gifting page. And this is something that Fidelity is able well, Fidelity has made it possible to do for parents. They can set up a gifting page. You can put a picture of your child, their age, their year that they're entering college, and their dream at two. And then you see this blue button here, give a gift. And that happens, a link is generated, and you can email that link out to family and friends, and they can gift money directly in to your account. So it's a great way, especially with really young children who maybe don't necessarily know that they're not getting a toy, to grow your fund. And then finally, involving your child in the process, is something that may seem optimistic to you, but kids like to see money that they have in their own name, and they like to see their balance going up. You could make it a rule, as I know some people do, that if kids get money, or if they get something for birthdays, or whatever milestone it may be, that they may have to save some of that money or put that in their college fund. I talked to a financial aid director at a college who said that she made her daughter save half of everything she got. And so not only did that help her grow her fund, but it became a habit that she just had later on in life, all throughout her adulthood, that she would save half of everything that she got. That idea of paying yourself first. So those are some strategies that we know have worked. Now, I mentioned this before, our college planning tools. Sometimes especially people who have really young kids, and they want to start off right and start doing the right thing, they call up and they say, how much money do I need to put away every month to have college paid for by the time my daughter is, going to college? And that's a really hard question to answer. And it's hard for a few reasons. Number one, we don't know where the child is going to go to college, and colleges have vastly different costs. We also don't know how much they are going to get in financial aid, so their income and things like that. So sticker price is important, but also the amount that you actually will pay is going to be different than the sticker price. Remember, there's financial aid available for most families. And of course, the market is another thing. We don't know what that's going to do. So what we have here is MEFA's college planning tool, and you can find this on MEFA.org, and it can help you to answer this question. And so you can create a profile as a family, put in, mom and dad and kids, and so based on the age of your child or children, they'll calculate how expensive certain colleges may be by the time your student is ready to attend. So you can search colleges, and you can input colleges, types of colleges, or actual colleges. And you can see here on this graph, it will say, by 2032, for example, this particular college is going to be $59,000, whatever it may be. And so you say, okay, that's how much it's going to be. And you can put in how much you've saved and how much you are saving on a regular basis. And it will say, okay, by that point, you'll have $32,000 saved for college. And you can change the market return, from 5% or 4%, 6%, 7%, whatever it may be, depending on the market behavior. And lastly, you can put in your income to see how much financial aid you may receive. Now, this is gift aid. This doesn't include loans, doesn't include things like work study. It's just gift aid. So it's grants and scholarships. It's money that's just taken off the bill. And so when you put all those three things together, you can see a picture forming. So in this case here, I'm not sure if you can see it, but I hope you can. It says this particular college, whatever it may be, is going to cost $59,995 per year. You're eligible for $7,073 in gift aid. At the rate you're saving right now, you're likely to have $32,002. And so your shortfall for the first year is $20,920. So after the first year, you're going to go through that savings, assuming you're spending it all in the first year, and your cost is going to increase by $32,000. So you either have to start looking at cheaper colleges, you need to increase your saving, or maybe you start applying for scholarships, which you can also do through that site. So it's a good tool to use. It's all projections, it's all estimates, but it gives you an idea And so that's on MEFA.org in our planning for college section. So if you're curious about that, you can go and take a look at that. I wanted to just briefly mention this. It's the compound interest discussion, and it basically is going to discuss the value of starting early. So in this hypothetical example, we have Julie who starts saving $50 per month in a 529 account when her child is first born, which of course you can do through the Baby Steps program. Now me, Jonathan, I am going to start saving a little bit later when my son is in second grade. But to make up for it, I'm going to start putting in $100 a month. I know I start a little bit later, which by the way, is not that late. The second grade is not that late. Don't worry about that. But who will have more money saved when their child turns 18? Let me see if I can launch this poll here. Yeah. See if you know. Got a couple of responses here. All right, I'm gonna cut it off here. Yes, I don't know if you can see that, but 75% of you were correct that it was Julie. Thank you for whoever voted for me. I appreciate that. But Julie's going to have more money set aside than I am by the time my child turns 18 and is ready to go to college. As you can see, the breakdown is right here. Now, this assumes a 7% annual investment return, which is a figure that we get from Fidelity, who tells us that over the course, over the long run, that this is a realistic estimate. So I know things may be different now, but that's what they have assured us. Julie starts saving $50 in a 529 account when her child is first born. She's going to have $21,536. So of that, that's actually going to be $10,800 of her own money that she contributed throughout the years. But it's almost going to double, just shy of doubling at this rate of return at $10,736. Whereas I put in a lot more. I put in $13,200. I'm going to have a good amount of money, but not quite as much as Julie. I'm going to have $19,798. I'm going to earn $6,598 in interest. So again, just assuming this rate of return, and that we're saving monthly until the child turns 18. This is the difference. So this is just shows you sort of the impact of saving earlier, even a little bit. Now, we're going to talk about how families actually do pay for post-secondary education. Now, I define post-secondary education as college and career training programs. And so when you're on the, when you're on TV or when you're looking on online or, whatever you may see, every sort of fall, you get these stories that college now costs $60,000, $70,000, whatever it may be. The costs can be quite high. And the big sticker prices are the ones that, of course, make the news. So one thing I will say that there are all different kinds of schools. And those particular colleges that you hear about, the big expensive four-year are your four-year private colleges. And so this, excuse me. This data here is taken from a national publication by the College Board called Trends in Student Pricing. This is from the year 2021. So it's fairly recent, but these are national averages. And so the national average for the yearly cost of a four-year private college or university is $66,800 per year. This is not just tuition, it's tuition, fees, room and board, books, supplies, transportation, other expenses. This is everything all together, known as the cost of attendance. And so the national average for 1 year for a four-year private college is $66,800. Now, in Massachusetts, in New England, if you're in this area, four-year private colleges, like, a lot of things in this area, it's going to be more expensive than that. It's going to be a little bit higher than the national average. But this is the national average. Now, if you go to a public college or university in your state of residence, then you're eligible for a tuition break, a discounted tuition. And so for a 4-year public college or university, the average cost for in-state residence is $27,330 per year. Now, if you go to a public college or university outside your state of residence, you're going to lose that lower tuition. So the average cost for an out-of-state student at one of those colleges, for a public college or university, is $44,160. But you can already see there's quite a variance in just the sticker price. So from $66,000 as a national average for private colleges to $27,000 for in-state students for public universities. This is like your UMass, Bridgewater State, Framingham State. This is if you're a Massachusetts resident and you're going to one of those colleges. Now, vocational schools, it's harder. This is not from the College Board Trends in Student Pricing. This is from a publication called Value Colleges, University, Community College, or Trade School, which makes the most economic sense. And vocational schools are sort of harder to all lump together because there is such a variance in program type and cost. But the best number that I could find here is less than $33,000 for the entire education. So, that might not seem like a really low cost, but you think it's for the entire education. So if any one of these 4-year colleges were to charge that, it would be just over $8,000 a year. So it is much less than the previous two. But again, there's so many variances of different types of vocational programs, a lot of them actually being done at 2-year public community colleges, which sort of brings us to 2-year public community colleges, which oftentimes are, certainly in terms of college, the least expensive options. And so the average 2-year public community college nationwide costs about $9,500 per year, not including room and board. Some community colleges may have room and board. Most of them, I think, do not. None in Massachusetts do. They're all commuter colleges. So the average tuition and fees and overall cost minus room and board is about $9,500 per year. So two things I want to make clear about this slide. Number one, you can already see, we've already talked about, that depending on the type of college, there's really a big difference in cost, right? There's a huge amount of variety of colleges and a huge amount of variance in cost. The second thing I want to mention is that this is all before financial aid. All right, so these are sticker prices. This is not including financial aid, which once again, the vast majority of families will be eligible for some level of financial aid. And so as we see here in the year 2020, 2021, at the top here, there was $175.1 billion awarded to students in financial aid. That number is actually down a little bit from previous years. It was in the $180 billion figure. So there's quite a lot of money every year given in financial aid. And financial aid can be sort of granted based on two metrics. The first of which is merit-based aid. So when you hear about merit-based aid, these are things like, these are scholarships. And scholarships based on student achievement. So things like academic scholarships, artistic scholarships, athletic scholarships. Merit aid doesn't have, your finances, your savings, your income doesn't have any bearing on merit-based aid. This is all in recognition of student achievement. And the first thing to understand about merit-based aid, most of it comes from colleges and universities. And colleges and universities have different practices and different policies when it comes to merit scholarships. Some colleges give out a lot of merit-based scholarships. Some colleges do not. It all depends on their capability and on their policy. This is something you can ask them. You say, do you do merit scholarships? And they'll tell you. But it's not just always, the big expensive schools that give out scholarships. Harvard University, for example, everything that they do is need-based, not merit-based, which brings us to need-based financial aid. And most financial aid, so most of that $175 billion is need-based, not merit-based. And so what that means is grants from the federal government, grants from the state, the college, need-based programs like work study. These are based on the family's financial eligibility, the family's ability to pay. And this is what is determined when you put in all your financial information into the FAFSA, is your financial need and how much need-based financial aid that you're eligible for. And so, as I said, 529 accounts, U-Plan accounts, things like that, if they're held by the parent, are going to be looked at as parent assets in terms of these financial aid applications, which again has minimal impact on your eligibility for financial aid. So as far as how families end up paying for financial aid, there's four main avenues that they can choose. So first is financial aid, and hopefully you get a good financial aid offer. And, that really eats up a lot of that college cost. Once that is done, there are basically three ways. So past income, meaning anything that you've saved, maybe any gift from a relative or something like some asset that you can leverage. Present income, meaning your salary when the student is in college. Now, of course, I don't think I know anybody who can pay for a semester or a year just with the salary that they're making left over, from all their other expenses, as their child is going to college. But it is worth it to pay what you can out of pocket. There are things called interest-free monthly payment plans, and colleges offer those through third parties. And basically, whatever it is that you can pay in a month, you can get on a plan and say, if you can pay $200 a month over 10 months, you set up that monthly payment plan. And then every dollar of that goes against tuition. So that's $200 a month over 10 months is $2,000. So that's $2,000 that you're not borrowing. That's $2,000 that you're not paying interest on. Because the only thing that's left after financial aid, your savings, and anything that you're paying out of pocket at the time is future income or loans. So the student is going to have, probably their own loans through the federal government, the federal direct student loans, the ones that have been in the news lately. But there are loan limits associated with those. So, and they're already part of the financial aid offer. So if you have, a financial aid offer that includes federal loans, and you're looking at a balance that you have to pay, the student's already taken out all the loans that they're probably going to be able to get in their own name only through that federal loan program. Anything after that, as I said, that there are loan limits associated with that. So for example, freshman year, students can borrow $5,500 in their own name. Anything after that is going to have to be credit approved. So whether or not you're borrowing through the federal government in the parent loan program, or you're going through a private loan like the MEFA loan or a Sallie Mae loan or a bank loan or whatever it may be, those loans are going to have to be approved based on credit or credit and income. And most students, of course, do not have the capability to be approved on that basis without a co-applicant. So usually that means the parent. It doesn't always have to be the parent, but oftentimes it is. And so if you are a co-applicant on the loan, you are just as responsible to repay as the student is. So, if you're just sort of rule of thumb math, sort of a very general estimate, if you borrow $10,000 to pay for college, your monthly payment is probably going to be $100 a month. So maybe that's okay for the first year, but if you borrow $10,000 every year, that's $400 a month after the student graduates that you're going to be paying. And your name is going to be on that loan too if you're a parent. So how much you're borrowing, that monthly payment, getting that down is going to be very important, not just to the student, because I hear from a lot of parents who are very uneasy about sort of saddling, as they put it, saddling their students with debt. But it's not just the student that winds up with debt. Oftentimes it's the co-applicant, it's the parents, it's grandparents, it's aunt, uncle, whoever it may be, that are just as responsible to repay as the student. So that loan amount and getting that as low as possible is going to be very important to you as a co-applicant if you're a co-applicant. So the next steps, you can start to save if you haven't started saving, and continue to save, please do. If you have started saving, talk to your child about college. It doesn't have to be about cost, but it can, you can talk about that too. But I think it's important to sort of foster a healthy attitude and to not sort of let peers and other sort of factors make the decision to what's a good college, what's not a good college, what's a worthy college, where should I go? But stress to them that it's important for their future that they attend a college. It's going to set them up well, and part of that is going to be repaying debt. You can go online. You can use that MEFA college planning tool if you want. You can visit our future college cost calculator. You can look at an EFC calculator, find out how much you may be expected to pay once financial aid has been taken into account. If you know specific colleges that your student is interested in, you can use a net price calculator. Every college is required to have a net price calculator on their website. And what that does, it's a few minutes. You go in, you put in some basic information, and it should give you an idea of how much financial aid you're likely to receive at that college and how much you'll be, looking at as a balance. You can take a look at our webinars that we have coming up and join our email community at mefa.org. This is our social media sort of platforms. You can take a look. We post scholarship information a lot on these social media channels. So if you're interested in scholarships, it's just something we didn't really touch upon too much here. That's just something you should follow. I'll put in a plug for the podcast, the MEFA podcast, where we discuss all sorts of things related to planning, saving, and paying for college. And I host the podcast, so I want you to listen to it. If you enjoyed this, please check it out. Otherwise, if you have any more questions, hopefully I answered the questions that you have. If not, or if you have other questions, I'll be here to take them. Okay, well, in that event, good luck to everybody. You'll be getting a recording of this presentation. Please reach back out to me or back out to us, or feel free if you had to reach out to me directly with any questions that you may have on saving for college or financial aid or paying for college in general. So, okay, thanks. Well, the podcast is just called the MEFA podcast. So you can find it on our website, actually, or you can go to, wherever you find podcasts like Spotify or iHeartRadio or Apple Podcasts. We'll be there, the MEFA podcast. Okay, thanks, everybody.